series webinars. We've already done one on research and development credits, which if you'd like to view that, it's available. You can go through our website. It's on YouTube. This will also be posted on YouTube, and we plan on having one or two more webcasts in our series, and you'll be getting alerts for those as they come down the pipeline. So thank you for joining us. I'm an assurance manager at PDR, and we did some discussion amongst people at the firm on what we thought would be good webinars for people, informational, and we thought that these financial landmines would be pertinent to a lot of individuals. So the way this webcast works is we're going to go through 3 key transactions that are often encountered. Business acquisition, as well as disposing of businesses, purchasing, holding, and disposing equipment, and borrowing, servicing, and paying off funds, or taking out debt, in other words. I'm going to walk through each of these transactions and discuss some of the issues that occur, some of the problems that we've seen our clients run into at the beginning, middle, and end of these transactions. So this is based on what we have seen in real life. Some of these things might strike you as obvious, but they're not obvious because they have become problems for people. All right, so let's get started. We're going to start with business acquisition and holding your business with plans for sale, and then disposition of the business. So some financial landmines that come up during the acquisition process. So big, broad problem is failure to perform the adequate due diligence. Now, when you're doing a business acquisition, typically you purchase a business sometimes based on sales. A lot of times when it's a service industry, sales or revenues or cash flows. And then other times the business value is based on the assets of the business. So depending on how you're looking at this company that you're purchasing, there's different landmines that present themselves. So overall, GAAP financial statements. When you're looking at a business, you need to understand what you're looking at. A lot of times, especially with smaller businesses, the numbers are getting are not necessarily GAAP. So you might be looking at numbers that are on a tax basis or just are incorrectly presented. So knowing that you have GAAP financial statements and GAAP numbers that you're looking at is key. Perfect scenario, you have audited financial statements. Reviewed financial statements would be good as well. Worst case scenario, compiled. And even once you have those, you're going to want to do your own due diligence to be comfortable that the numbers truly are on a GAAP basis and you understand what they're showing. Things that get overlooked a lot of time, officer salaries are often not factored in, especially in pass-through entities. You'll see companies reporting prior to distributions. So there's been instances where people will acquire a business and they will start running the operations and wondering why they are not making enough money. And the problem is that their own salaries as owners were not factored in. Validation of sales. If you're purchasing a business based on sales or revenues, understanding the nature of those sales is very important. Sometimes you will find that the sales are inflated because there are related party transactions in there. So you might see a lot of those customers disappearing when you take over the business. There's often contracts in place that, where the previous owners will have contracted a certain revenue amount or a certain sales amount with a customer. And then when those owners are gone, that contract becomes null and void, those sales are out the window, and you're left with a stream of sales that aren't nearly as high as you anticipated. Also, if you're looking at future numbers, cash flows, future cash flows, it's very important to understand the assumptions that are being factored in. There was a case where the 5-year future cash flows were being used to determine the value of the business. However, because of a failure in due diligence, inflation wasn't factored in. So the value that was paid was incorrect because of that. So there's a lot of different assumptions that go into future numbers, and you have to have a firm understanding of, are those assumptions reasonable based on historically what has happened. Now, if you're purchasing a business based on asset value, making sure that those assets are accurately stated is important. Accounts receivable is typically where you run into a problem. You purchase accounts receivable. There's an allowance for doubtful accounts factored in, but that allowance is just not sufficient. And there's been many situations where you'll see businesses, they bring in these accounts receivable, and then the collectability on them is just not, just not what they anticipated, and they take a hit. Also, another problem that often pops up is related to inventory and equipment. A lot of times in the more sophisticated acquisition, you'll have valuations done on inventory and or equipment. But if not, you need to do very good due diligence regarding the quality of that equipment and inventory. There have been situations where equipment is purchased, a manufacturing company was purchased, they had the equipment, they were rolling along for a little while, doing fine. All of a sudden, equipment stops working, not nearly in the condition that they anticipated. Major cash outflow that had to occur to get the equipment back and working, and the value of the business just really was overstated when acquired because of that. So some kind of overall due diligence matters. Also, failure to understand the tax implications when you're purchasing a business. What you'll often hear is asset purchase and stock purchase. And the way acquisitions are structured, whether they're structured as asset or stock is going to really change the nature of the tax implications. So having an understanding of how your purchase is structured and what liabilities come along with that. So for instance, in a stock purchase, you're going to have a lot more tax exposure at the federal level. Now that being said, you always need to be aware of the tax implications. Where problems usually pop up is in the state sales, income, and franchise taxes. What states you choose to file taxes in is somewhat judgmental. So having an understanding of where there is potential problems, where potentially the company should have been filing and maybe wasn't filing, you need to be aware of that because that can come back at a later date and become your problem. Payroll tax is another big one. The government is very, I'm sure you all know, the government really wants payroll taxes to be handled appropriately. If they're going to be upset about anything, it's going to be that. And they're going to get their money. And even if you're structured in a way that you think is protecting you, like an asset purchase, you have to be very careful with payroll taxes. Excuse me. Another tax implication, cost segregation studies. There's been some cases where a purchase acquisition was set up and costs were allocated at that time, and then the company later came back and did a cost segregation study and tried to get some tax benefits from that cost seg study, but because their purchase agreement was contrary to that cost seg study, the IRS did not accept it. So doing any sort of cost seg study on big buildings and property that you're purchasing, doing that up front at the time of the acquisition is important. Another big pitfall, failure to appropriately structure your entity correctly. So when you're initially setting up the company that is going to be the remaining entity, making sure that you handle those legal matters correctly up front. A lot of LLCs and S-corps are set up with not operating agreements that really aren't complete, that they aren't thorough enough. Buy-sell agreements that are put in place that aren't thorough enough and that the new owners don't have a real clear understanding on. So setting up your initial structure appropriately is important. Understanding what you're really paying for the business. Once you're paying outside of cash, it gets a little sticky when you start having deferred payments, assuming liabilities, anything that's not straight up cash, you need to make sure you have a clear understanding of. One of the things that often occurs are problems with contingent payments. So if you have a purchase agreement where there is a contingent payment, maybe a payment based on what your working capital is, 12 months down the road, or what your revenue stream is, you need to make sure the buyer and the seller that documentation is very clear, that you both agree on that calculation, you both agree on the timing of that calculation, and when those amounts are going to be paid. So sometimes that wording can be a little bit vague, and it causes problems on the back end. So being very clear on the contingent payments is important. All right, let's see. Failure to focus on business risks. All right, so we've been talking a lot about the financial statement, but do not lose sight of what is not on the financial statement. This is one that entrepreneurs tend to do pretty well at because they are so focused on the business and not necessarily the financials, but understanding what doesn't show up in the numbers. So concentrations in customers, if your sales are made up of one large customer, that could be, problematic. Risks that aren't necessarily on the balance sheet. Warranties, sometimes there's a warranty in place. You might have a small liability on the balance sheet, but that risk that's out there associated with it might be larger. Litigation, be careful with what litigation might not be might be coming down the pipeline. What your responsibility for any litigation that the seller might not even know about right now. Understanding what could potentially be out there. Loss of employees. This is a big one. If you're bringing over employees from the company, making sure that the appropriate non-compete and employment agreements are in place, because if you lose a couple of your key employees, it could be a real problem. So understanding those business risks that aren't maybe right, up front. And then this one, it seems real obvious, but it's probably what we see the most, and that's failure to engage the appropriate support, specifically your attorneys. There's a lot of attorneys out there and a lot of attorneys who will say they work in this area, but make sure that they have the appropriate experience. Make sure that they have the experience for your industry. Business acquisitions in different industries are going to be different. So make sure you get good recommendations from your accountant, from others, and do some cross-checks on those recommendations. All right, so operationally in mind. So let's say you now have a business and you're running it, you're in the operations mode, but you're looking to dispose of it down, shortly. What do you need to do? What are some of the problems that people run into during that operation phase? Excuse me. Number one, understanding where you stand compared to everybody else. So you really have to know where you stand within your industry as well as within your own geographic region. When it comes time to sell your business, you want to have some history to show where you stand. Benchmarking is key. You see a lot of different dashboards nowadays. So any sort of benchmarking with your industry and geographic region, so you have that backup support when it comes time to sell. Reduce your concentrations. Things that are going to bring down your value is if you have these big customer concentrations or a big reliance on certain vendors. So, trying to minimize those impacts. Employment agreements, non-compete agreements, again, things that could end up bringing down your value if you don't have those appropriate non-compete and employment agreements in place. When someone comes in to buy your business, they're gonna, that's going to drive down the value because there's more risk for them there. And again, outstanding litigation and regulatory matters. Again, some of the things you think about when you're acquiring. Now, as you're running the business, you need to be thinking about when someone comes in to acquire from you, how are they going to view these things? So getting litigation, regulatory matters in order. From a benchmarking standpoint, PDR does offer profit sense. We can do a complimentary industry report, kind of give you an idea of what your industry looks like. As well as we, can work more in detail with your company. So, all right. So disposition. So now it's time to dispose of your business. After dispositions are done, there's been some research on what went wrong. So you dispose of your business. What are these prior owners saying went wrong? And the key, what went wrong, is that they misunderstood how the deal was structured. And again, this is when you get outside of cash, when you get into deferred and contingent payments, if you don't have a firm understanding of what that time value of money is doing, you can end up undervaluing your sales number. Need for liquidity. business owners who get into a position where they are desperate for cash, so they're willing to accept less than the company is actually worth, and not having a formal competitive process in place. So these are some of the things that, have become problematic during the disposition period. So due diligence, once you're in that disposition, due diligence, 100 times over, when we have companies that are selling and going through the due diligence process, the horror stories will go on and on. Big problems getting into due diligence too soon, granting exclusivity too soon, and not being thorough and deciding up front what the due diligence process is going to look like. Because what's going to happen, I can almost guarantee you, is that it's going to be way more overwhelming than you expected, and it's going to go on a lot longer than you expected. So you need to set clear rules up front on what deliverables are going to be required, what is the timing of those deliverables, and then who's going to be providing those deliverables and doing that work. Because what happens a lot of times is you have your operational people getting involved. They're now taking their eyes off the business, they're focusing on this whole due diligence process, and your operations start to slide. If this due diligence then falls through, now you have a company that's not doing as well, and you're out there looking for a new buyer. So really defining what the due diligence process is going to look like is important. All right, leaving the business acquisition and disposal side, getting into equipment. So I'm being kind of general here with equipment. This could apply to property as well, but I'm going to be just using the word equipment kind of generically. So one key failure to invest soon enough. There was a study that said in manufacturing plants, if the median amount of repairs and expense that are unplanned is about 10%. If you have unplanned repairs and expense that are below 10%, then those companies have gross margins that are 10% better than the other companies. So the key here is make acquisitions of equipment soon enough. Don't put it off so long that you end up harming your productivity. So what goes wrong once you decide to acquire equipment? Number one, acquiring it in the incorrect acquisition with the incorrect method. So for instance, you can buy equipment with your working capital, just pay cash for it. You could take debt, which could be a short-term credit, it could be long-term credit. You could do a lease, capital lease, operating lease, and one kind of overlooked one is actually customer financing. If you have a piece of equipment that you're purchasing because you're going to be making something specific, mainly for just one customer, you have the option of that customer financing and owning that equipment. So being aware of the options out there and understanding how those options are going to impact you from a cash flow as well as a financial reporting perspective is important. Failure to understand the implications on your financial statements. All right, so here's a big one that pops up. You have an operating lease. Let's say it's a 5-year operating lease, and you think, okay, well, this isn't even going to hit my balance sheet. It's just going to be an operating expense. Well, if your operating lease is accelerated, meaning let's say you start out paying $1,000 the first year, and by the 5th year you're paying $10,000 a year. For financial statement purposes, you have to even out that expense over the life of the lease. And what typically ends up happening is in the early years you have a liability sitting on your books. So what we've seen is now these companies have liability on their book, and it throws them out of compliance with their debt covenants. So what you thought was a non-balance sheet operating lease ends up throwing you out of compliance because of a net asset calculation required for your debt covenants. So even operating leases can impact your balance sheet. Another one is capital versus operating. How you report a capital lease versus an operating lease is going to differ. A lot of times if you have debt, your bank requires you let them know if you're going to take out any additional borrowings, and that would include capital leases. So if you enter into a lease and you don't realize it's a capital lease and you think you're just, going to be paying out your monthly operating cash for an operating lease, you find out now this actually has to be recorded as a capital lease, which shows up as debt, as a liability on your financial statements. You now have to turn your financial statements over to the bank, and they're asking you, why do you have this new debt that you did not tell us about? You're now out of compliance with your debt covenants. So understand how these leases are going to show up on your balance sheet. And again, will impact on debt covenants. We kind of already talked about that. So carry on. Okay, failure to take advantage of incentives, tax incentives. There's a variety of tax incentives out there related to equipment purchases. The key here is take advantage of them up front. It is more difficult to get these incentives and exemptions on the back end. So do this up front. Federal bonus depreciation, R&D credits, sales and use tax exemption. Florida actually expanded their manufacturing equipment sales and tax exemption, so that's gotten larger. So, talk to your accountant, understand what the advantages and incentives are out there, and make sure you're taking advantage of them up front and not putting it off. All right, so now you have this equipment and you're operating it. What are some of the pitfalls? Failure to amend insurance is a big one. You buy a piece of equipment, there's a fire, you forgot to amend your insurance policy, and now you have no coverage on that equipment. So make sure that as you bring this stuff into your locations that you are amending your insurance. Failure to adequately track inventory. There's a cost benefit here, how closely you're going to track your inventory of equipment. But I would recommend at least doing an annual, walkthrough to understand what you don't have anymore. And then failure to take advantage of tax incentives. Repairs and maintenance, there's some new regulations related to that that just recently came out. So be careful that you're not overcapitalizing. Make sure that as you take care of this equipment, you're expensing what you can expense. Dispositions, at the time you get rid of your equipment, a big one, and this kind of goes back to the inventory tracking, make sure you report when you are disposing of equipment for tangible personal property reasons. So, for instance, you have a piece of equipment, let's say it's fully depreciated. You got rid of it, 5 years ago. You don't really care. It doesn't really impact your balance sheet because it's sitting on your balance sheet fully depreciated. So zero impact on your balance sheet. However, if you don't accurately report that on your tangible personal property tax returns, it's sitting there with a residual value that you're paying taxes on. So you need to track what's really being disposed of so that for these tangible returns, you can be accurate and make sure you're not overpaying. Underestimating the cost of disposal, this is something you really have to think about at the time of acquisition, keeping in mind what the cost to get rid of that equipment is going to be. And then UCC filings. If you sell your equipment on disposition, if you are selling equipment and you are putting a UCC on someone, keep in mind these terminate automatically after 5 years, typically. So if you have sold something and you have a lien on it or a UCC on it, and it's for longer than 5 years, make sure you're refiling. Simple process. Okay, borrowing, taking out loans, borrowing, servicing, and paying off funds. This slide is probably the best slide from where we see people not understanding the impact of cash flows for what they're borrowing. So this slide is worthwhile to take a moment to really understand. This is assuming you have a note payable that you're taking out, and it has a 10% interest rate, and it's a 1-year term. So to repay that debt, it's going to take $110,000, $100,000 for the principal and $10,000 for the interest. So what we find is that clients will think that, okay, well then they need to go make operating profit of $110,000 cash flow. That's not actually true. You'll see here when you factor in the income tax expense that you're going to be paying on your net income, you actually have to bring in $179,000 in operating profit. So be aware that you're paying with taxed dollars to pay back the debt. It's not a one-for-one with your operating income. Okay. Understanding the impact of the covenants. When you're entering into debt, I cannot stress this enough, understand what your covenants are going to be and how you're going to handle them going forward. So what we see a lot is people anxious to get their, note signed, enter into these covenants that are unrealistic. And then every year or every quarter or however often the bank requires you to, you're begging them for a waiver on your covenants. Typically, it's going to be a debt service coverage ratio. A lot of times you'll see this with not-for-profits where you don't typically have a great big bottom net income number, so it's difficult to meet debt service coverage ratios. So work with your bank, understand what your covenants are and how, if you're going to be able to meet them going forward. Also understand that usually there is cross default. So let's say you have a mortgage on your building with your bank, and you decide to take out a line of credit. Well, you take out this line of credit, and it has a debt service ratio, and you can't meet it, and you are in default on your line of credit. Well, usually when you're in default, the note gets shown as current, which never looks good, but a line of credit would be current anyway, so it's not that big of a deal. The problem becomes your mortgage. Usually, if you have this debt at the same bank, you have the cross-default provision that says, hey, if you don't meet your debt covenant in any note that you have with our bank, all your debt is in default. So now all of a sudden you're having to show your $1 million mortgage as fully current in your financial statements, which depending, if you have debt with other banks, it's just going to be a big mess. So understand what your covenants are and understand how they're impacting the other debt that you're holding. Some actually, you'll occasionally even see covenants or loan agreements that say if you're out of compliance on a covenant, even with another financial institution, that you default on your note. So it's important to understand that. Cross-collateralization, same sort of concept. A lot of times there'll be wording in notes that say that the note isn't collateralized by, let's say, your accounts receivable, but also any other collateral that you may have outstanding with a bank. So, understand what you're cross-collateralizing as well as cross-covenants. And the impact on your financial statements. One of the things that I've run across specifically that caused a lot of trouble for a client, they entered into a line of credit, and it was a long-term one. It was a loan. It was a long-term loan. It wasn't due for over a year. So they were anticipating having that loan showing up in long-term liabilities. Well, the loan had a lockbox associated with it, not a big deal, but it also had what's called a subjective acceleration clause. And what that is it's a clause in the debt agreement that says the bank can basically call the note anytime they think the business is going downhill. So it's a subjective. Subjective acceleration is a very good description of it. Well, when you have the subjective acceleration, typically that's not a big deal. When you have a lockbox, typically not a big deal. However, if you have both of those, it triggers under GAAP that you show that debt as current. So now the company has this long-term debt that they're having to show as current under the GAAP requirements. Now, it's not really current in the sense that they weren't going to have to pay it back in a year, but it was required to be presented that way. Well, now they disclose this in the financial statement notes, just set it to GAAP requirement, blah, blah, blah. But their vendors and customers who were looking at these financial statements, they had to take a lot of phone calls to explain that situation because it just, even though it was explained in the notes, it looked scary to the vendors and customers that all this debt was current. So keep in mind how this is going to impact your financial statements, especially when you're entering into complicated debt that has a lot of terms. Honestly, not many people are going to know that little caveat about lockbox and subjective acceleration clause. So getting your accountant involved up front is important. All right, operational landmines, a couple things we've seen. Budgeting for covenants, I talked about that a little bit ago. Best case scenario, when you're doing your budgets, factor in your covenants so you can see when it's going to be a problem coming, sooner than later. You can start working with your bank, maybe even amend your covenants. Places that I've seen clients get into trouble, amendments. Occasionally, you will amend agreement for whatever reason. Maybe you're changing your covenants, maybe you're extending it. Well, banks will occasionally, I don't want to say sneak, but they will put things in there and companies don't realize it. So, for instance, we had a company and they were amending their debt to extend the term on it. And in the process, the bank put in some verbiage that they could take out additional UCCs, and that's all a UCC is. All you do is sign away the fact that they're allowed to file one. You don't sign the UCC. You don't say, yes, you can put a UCC on my building. You just sign your note, which has wording in there that they can UCC you. So what happened is they signed this amendment. The amendment had some kind of vague wording. The bank went and put a UCC on a different piece of property that had nothing to do with the note. Well, the problem was there was already a note from another bank on that property. They then see this UCC by another bank, and it throws them into default on their other debt. So be careful what they're changing other than just the straightforward terms you know about when they're doing amendments. Guarantees is another place I've seen this pop up. We had a client who had some debt. It had a good 20 guarantors on it. Well, they attached a new guarantor list to it and added a couple more of the affiliates. The guy signed the note, signed as guarantor, didn't really realize that additional affiliates were on there because there were just so many to begin with, and they ended up having more guarantors on that debt than they even realized. So just be careful when you're signing the amendments. They're not always that straightforward. And finally, last thing, disposition of debt. Failure to have UCC filings removed, that is a process the bank has to go through. It becomes a big hassle when banks switch owners, when they're bought out or when they go under. So as you pay off your debt, do a UCC filing search on your company. Make sure these things are getting pulled off. And then understanding the implications on your tax planning. As you pay off your debt, you're not going to have the interest expense that was originally out there. So, be aware of what implications that's going to have. All right, well, that's it for today. This is a list of our services at PDR. If you all have any questions or would like to reach out to us, want any more information on any of these matters that we covered, feel free to give us a call. You can give me a call, Mary Postangle, or anyone here, actually. And thank you for joining us.